Welcome to this week's podcast from Interactive Brokers. My name's Andrew Wilkinson. Joining me, Chief Market Strategist Steve Sosnick. How are you, Steve?
I'm wonderful, Andrew. How about yourself?
Doing well after the long weekend. Investors got off to a bit of a shaky start on Tuesday when they returned. Two negative catalysts. I want to jump straight in here. We're awaiting a decision on Trump's motivation to fire FOMC member Lisa Cook, which has far-reaching implications for control at the Fed, a balance of power on the Fed. And the second issue concerning the Fed is the rise in global bond yields at longer-dated maturities on increasing concern over fiscal deficits. Which one of those do you want to take first, Steve?
I think let's go with part two first, because I think it's very tempting for U.S. investors to think specifically U.S.-centric, but while the Lisa Cook story has potentially huge ramifications for the U.S. bond market, I think it's important to keep in context what's going on globally. And I will argue the U.S. bond market is holding up rather well compared to a lot of its major government bond market peers, such as the UK, where long-term gilt rates have been the highest they've been, I think, in about 28 years or something like that. In Japan, where we've seen the 10-year and certainly the 30-year rates really zoom. France, we're seeing a bit of a crisis of confidence in their bond market. Although the U.S. long bond, the 30-year, has tested the 5% level a couple of times recently. And the 10-year, as you noted, is around 427. That's not so bad. The 5% level on U.S. bonds is a little bit tempting, shall we say, because I do think that because the market has defended it so well, this morning we saw it get right up close to that number. And as we're speaking now, we're about 5 or 6 basis points below that. So it's clear that there's demand at the 5% level. My fear, of course, is if it breaks beyond that, you probably go right to 520, which is the longer term high yield for the 30s. So that's the concern I have. Looking more specifically at the Lisa Cook situation, there are big ramifications here, but it is important to remember that the Fed doesn't really have a lot of control over the long end of the curve. They control the short end, and they have an input into how well inflation is controlled, which is pretty much the primary determinant of the spread between shorter and long-term rates. But unless they actively implement some sort of quantitative easing or quantitative tightening, the former is possible. The Fed runs the risk of, if they over loosen, if they get too loose at the short end and stop worrying about potential inflationary impacts, or are seen as not sufficiently vigilant against inflation, then the long end of the curve rises and the spread steepens. The question is, do you get what's called the bull steepener, where the curve generally shifts down? It's just the front end of the curve shifts down faster than the back end, or you get a bear steepener, where basically the front end stays relatively stable or rises, probably not going to rise in the short term, but stays relatively stable, and the long end rises. So there's a lot of moving parts here, but I think threats to Fed independence certainly are not wonderful. Look, I'm not going to handicap the court case because that's just not what I can do. I'm not a lawyer, and I'm not going to play one here on a podcast. But it would seem that the arguments were compelling. There have been a lot of very prominent voices reaffirming the need for Fed independence, not least of which was Thomas Petterfy, who did it on CNBC last week, and Ray Dalio, who did it the other day. I think Ken Griffin did it as well. There are some very big, prominent names in the financial industry pushing back on the idea of reducing Fed independence. I would like to think that the administration listens to those almost regardless of how the court case goes.
And judging by how the market rebounded yesterday into the close, I think the market's getting a sense that things will turn out okay on that front. A shaky start to begin September, but then the next hurdle at the end of this week, Steve, is the August employment report. How big a deal is this one going to be?
Quite big. Just give me a second. I'm pulling up the numbers on my screen here. It's about as big as it gets. Now, remember, the Fed is concerned with the dual mandate, stable prices and maximum sustainable employment. At Jackson Hole, Chairman Powell shifted his focus, whereas I think it was very much, tell me why rates should be cut. to tell me why rates shouldn't be cut. It doesn't, it's subtle. The market, of course, loved it. And by the way, by about noon yesterday, we'd given back all the Jackson Hole related gains. But, and also parenthetically, the likelihood of Fed cuts is actually below where it was before he spoke, because I think the week before he spoke, there were Fed funds futures were pricing in about a 5 to 10% chance of a rate cut, a second rate cut, 50 basis point cut. By the way, Forecast X, though, as when I last looked yesterday at that contract, had about a 7% chance of a 50 basis point cut as well. So I would say our Forecast X customers are maybe a little more enthused than those of the Chicago Mercantile Exchange.
I don't mind those odds, to be honest, Steve.
You think 50 is in the cards?
Get it done and see what the White House has got to say after that.
I think, though, the problem here is twofold. Number one, you have we just lost whatever clarity we might have had on tariffs over the weekend. And I think that was part of the reason why the market sold off. Number one, the bonds sold off a little bit because it's widely believed that the big, beautiful law is going to increase deficits, and that tariffs at least were plugging some of the hole in that regard. That does not seem to be the case right now if tariffs get removed. So that adds a little fiscal issue to it. Secondly, if you're a company, how do you plan? We at least got to a point where you seemed like you could plan for what was going on, and now you can't. So the stable prices portion is less convincing than I think than it might appear on the surface. By the way, also on Friday, we got the core PCE number, which at 0.3 was bang in line and was actually 0.27, which of course is better than 0.3. But it was the fourth month in a row where core PCE rose very slightly, but it's going in the wrong direction. And also in Jackson Hole speech, the Fed reaffirmed the fact that the inflation target is 2, not something near 2, not something approximating 2, it's 2. So you have that mitigating against it. I'm going over this other screen just so I can make sure I have the numbers correct in terms of expectations. So obviously the last employment report was essentially a debacle because the revisions were so huge, and it led to political fallout, and it led to the head of the BLS getting fired, et cetera, et cetera. Technically, we don't really have a head of the BLS right now because the new person has not yet been reconfirmed by the Senate, which was out on leave. But right now, so the market, as I'm looking at consensus, economist consensus, you should go to Forecast X and see what our customers are saying. Non-farm payrolls projected to go up by 75,000, but who knows what the revisions will be. Average hourly earnings up at 0.3% stable on a month-over-month basis, and the unemployment rate is projected to creep up to 4.3%. The non-farm payrolls are such a wild card at this point. Who knows? Also, what's interesting is we fret over some of these numbers, but they're actually quite minuscule in regards to the size of the number of employed people in the country. We're talking about tiny rounding errors, but they mean a lot at the margin to the market. But I think an unemployment rate that's moving in the wrong direction is a clearer signal that employment is challenged, the labor market is challenged, because that's a very visible number. You know what? If you ask the person on the street, we have non-farm payrolls of 75,000 vis-a-vis non-farm payrolls of 250,000. What does that mean to someone? If you say to somebody the unemployment rate is 4.3% or 5.2%, believe me, they have an opinion on that one. So I do think that would be the key here, and we'll see. But to a large extent, a move is priced in. I guess a truly horrible number would say take the odds, as you say, by the yes at 7 on the 50 basis point cut. I don't see that happening. I just don't see the Fed's likelihood of moving that quickly. But it's not out of the realm of possibility. But again, we'll know soon enough. I think they want to get a cut off the table. I think they just want to be done with it and stop talking about it. The question is what's required going forward, and we'll learn a lot more about that hopefully on Friday.
8:35 a.m. Eastern time on
8:30,
Friday.
8:30.
But 8:35, we'll probably have a good answer.
Sorry.
We'll know. Steve, you've been writing a bit about seasonality. Tell us about what that means for stocks behavior looking back over many Septembers.
There is certainly the mindset that when the calendar flips to September, people get nervous. And to some extent, there is something to be said for that. Summer's over psychologically, at least in the Northern Hemisphere. And if you've had good gains for the year, people might think a bit more about how do I preserve my gains rather than how do I keep adding to them. Or put a little bit differently, you start to have risk aversion creep in rather than risk assumption, because this market's really been all about risk assumption for the last 3 to 4 months. The more risk you took, the better you did for the most part. And I think there is a little bit of a general psychological shift. We saw it start on Friday. Again, there could have been the Lisa Cook stuff. I think some of it had to do with the fact that the CPI, when you dug down, was not as in line as it seemed. And that certainly continued yesterday, I think initiated by global bonds and added on by its own factors. And then we did get a little bit of the buy the dip came in at noon once the selling abated. Traders are very astute to look for that. We got back about half our losses. But in terms of September, I did do some research on this. I actually ran the numbers. There are 4 months of the year that over the past 25 years using SPX, there have been 4 months that have had average returns below zero. So 8 positive months on average, 4 negative months. The negative months have been extraordinarily slight. And honestly, offhand, I wrote them in the piece. I don't remember exactly what they are. It's January. It was, I think, April or May, and it was, I think, June or July. Bottom line, and September being the main one, rather than showing very slight average losses, 0.2 or something of that nature or less. September was greater than 1% over the past 25 years. On the other hand, over those 25 years, 12 of them have shown up Septembers. So meaning your odds of September being up or down are essentially those of a coin flip.
Mhm.
Now, recent history has not been great. Last year, when we actually had a very solid, I think up 2% September, broke a 5-year down streak for Septembers. And those 5 down months were actually all relatively substantial, even in great up years. So that includes 2020, 21, 22, which was a bad year, and 23, which was a very good year. So there are reasons for some concern, but I don't want to trade based on the calendar. I think that's a little bit fluky. I think if you want to trade based on the underlying psychology, maybe that underlying psychology has changed, which is also afflicting bond markets right now. The generally more sober bond traders have become even more concerned about their risk reward. But in general, I don't want to overdo the seasonality. There's reason for people to be wary at this time of year, but it is not the only reason why one should be buying or selling stocks or changing one's risk exposure. I think it's always prudent to manage your risk. If it took the change in calendar to do so, be it. But it doesn't, but just the fact that the calendar's turned does not mean that we're going to be moving in one direction or another. Certainly though, yesterday I got asked that question an awful lot.
Steve, are you worried at all about the downtick in AI, NVIDIA, following its robust earnings last week?
No, NVIDIA was up 35% between its last earnings and the most recent, between the 2 earnings ago and this most recent earnings. It's inevitable that the mentality start to shift from just let's throw money at AI to let's make sure it's a profitable investment. There was the widely cited MIT report that said 95% of the dollars spent by end users on AI so far have not yielded a return. So at some point, you have to wonder, does buying more chips make sense? Now, in the case of NVIDIA, we're talking about awesome to less awesome in terms of its growth. So it's projected to go from 54% year-on-year growth to 52% year-on growth or something like that. Yeah, trees don't grow to the sky. Economic realities do take hold. Even Mark Zuckerberg, who was throwing money at AI people, as loyal as I am to this firm, feel free to throw me an NFL quarterback size contract. Come help you with your AI efforts. But even he said, maybe we did a little too, maybe we got to cut back on that a little bit here. So it's inevitable as any industry grows that it not necessarily do it in a straight line or particularly at a parabolic rate. Okay, so NVIDIA had a little bit of profit taking. Was it not due for some after the rally it had? And so I'm not really going to start freaking out. Yeah, the stock broke down through its 50-day moving average and bounces back a little bit. That's trading, and that's investing, and that's understanding that things are subject to pullbacks. As of now, it is just a pullback. I do think the talk is going to be more toward how is AI a profitable investment for end users, not just for the proverbial picks and shovels manufacturers. And if this is a gold rush, NVIDIA's Levi Strauss and every shovel maker rolled into one, then you have the AI providers, let's say, called Microsoft, Meta, et cetera, et cetera. It's working for them. But even there, you had Sam Altman come out, pretty much tell us that he's afraid that this is getting a little bit ahead of itself. So it's okay to take a breather. It's okay for the market to take a breather. That's all we've seen so far. Could it get worse? Yeah. Could it get better? Yeah, sure. But so that's why I don't want to overreact to a couple of days pullback after a company that by any objective measure put in, one hell of a quarter.
Brilliant. Steve, where are you going to be watching the numbers from on Friday? Have you made your mind up yet?
I'm actually going to be watching them from Yahoo Finance's studios, where I will be part of a live broadcast on that. So I know where I'll be.
Excellent. And I think the big thing to be watching for is the market's response at the 30-year end of the bond market to whatever comes out. That's going to be a key driver, we think.
I agree. This 5% level has proven to be somewhat impenetrable, but if penetrated, that could get nasty pretty quickly, but certainly for bonds. And I think stock traders would have no choice but to take notice.
Steve, thanks for joining me.
My pleasure, Andrew. Talk to you soon.
All right. Thanks to the audience, and take a minute to subscribe wherever you download your podcasts from. Bye for now.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Futures, event contracts, and forecast contracts are not suitable for all investors. Before trading these products, please read the CFTC risk disclosure. For a copy, visit our warnings and disclosures page. Interactive Brokers LLC is a CFTC-registered futures commission merchant and a clearing member and affiliate of ForecastX LLC. ForecastX is a CFTC-registered designated contract market and derivatives clearing organization. Interactive Brokers LLC provides access to ForecastX forecast contracts for eligible customers. Interactive Brokers LLC does not make recommendations with respect to any products available on its platform, including those offered by ForecastX.